Welcome to another episode of the weekly discussions. Today we don't have Joe here, but we'll still have some informative discussions, maybe more informative. Who knows? Welcome, everyone.
Thank you.
Yeah, so I'm just going to hit it off. What's in the news this week, especially in the US, and it was the charges that was dropped or out to Sam Bankman-Fried. Um, and if you don't know who Sam Bankman-Fried, he was the owner CEO of FTX. If you don't know, FTX is a lot like Luna is in South Africa, or not like Luna, but it's a trading platform for cryptocurrencies. But in the end, it was not a trading platform. I know those days when Bitcoin was all the hype in the end of 2021, Tom Brady was one of the sponsors. He was the one of the people spokespersons. Them everyone had their red eyes on their Instagram or on Twitter, and to buy FTX and to trade on FTX, and everyone wanted to crypto, and everyone got into that craze. And FTX was valued $32 billion. So insane for he was what 30 years old or younger, and he's a CEO of a company that's 32 billion. But they weren't only a trading platform. If they were only trading like Luno, you get a fee of the trades that was made, and that's how a trading platform makes money. But there was a lot of fraudulent activities. They actually took the money from the investors that you want to buy Bitcoin, and then they invested in their own stuff. So again, not part of the Ponzi scheme, but they believed, okay, they can do better with this money than Bitcoin. But when everything came tumbling down in the beginning of 2022, it's like when tides go out, you can see you swimming naked. So that's what happened to them. And what's I can't believe they actually got charges this quickly. And he got charged 110 years. And the jury normally sits for a few weeks, few days to say how long we're going to put this guy into jail. They only sit for 5 hours, and they decided we will give this guy a sentence of 110 years. So probably won't sit for 110 years. They say a few decades, but still, the guy's life is over. What's your opinion on that, Ruvan?
To me, it's actually kind of funny that they were major corporate investors who invested in and through FTX. I won't name their names, but you do know these big corporates in the USA. And supposedly they did their due diligence. And the due diligence that they did still made them invest through FTX, even though we know now afterwards all of the fraud that was committed by him and the CFO and probably quite a few other individuals there. So I think, to be honest, it's quite shocking. And like you said, there's a few celebrities that were endorsing FTX. Even Formula One racing team Mercedes, the major sponsor for them, Larry David, Tom Brady, and these people get paid quite a lot of money to endorse a scheme that they did not know was a scheme. And I think that is sort of also quite a big problem when people with a huge following endorse brands and financial things that they probably don't know anything about, which at the end of the day turn out to be a scam. I think that's kind of concerning as well. People with a major following being able to punt things that they don't know anything about. I think that's probably something to look into in the future.
And I think the irony about this is after the global financial crisis in 2008, I think everyone said the big banks, the big corporates is evil. So let's turn to crypto or the smaller guys that's going to save us from this bureaucracy. And then they turned out to be even a bigger evil than the guys they replaced. So, yeah, that's the irony in this.
Yeah,
Uh,
I think that's I think that's quite funny. Sort of poetic to see these things play out. Once again, I think last week we also spoke about these types of things where investment scams or Ponzi schemes. If you don't know what it's about, if you don't know how it works, if you don't know anything about it, don't invest in things you don't know anything about. Don't invest in things that are not registered. Don't invest into schemes where there's no recourse. Be careful, and even when it's that big, we can use other examples like ShareMax. That was also massive. Every single person in the Pretoria region knew ShareMax, and that didn't necessarily mean that you should have invested, and we know this now. So be very, very, very careful. Very careful.
And again, it's not the asset that's the problem. Like ShareMax used property and FTX used crypto. It's not to say that crypto and property is bad. It's bad people using the schemes. And I think when something new happens, like crypto, a lot of people jump on a bandwagon. No one really understands. And exactly, they invest in stuff they don't understand. What's scary is, like you said, these big corporates that invested in FTX, they're supposed to do the due diligence. And we say we need more regulation, and I think it's good that there's more regulation coming into crypto and advisors. And it's actually more to protect the consumer, again, because now you have a recourse, like you said last time as well, that you can go and use it. But then you also have something like Steinhoff that was very regulated by the JSE and everything, and it still doesn't happen. I think that's why, if you look at stuff like this, where diversification even becomes more important, because you don't know what's a scam. So it's very a negative view to have, but you have to be diversified. And again, if something just goes up or you believe there's only upside potential, then you know there's something wrong. Like ShareMax is they promise these returns. Crypto, you're gonna get these returns. It doesn't exist. So if you invest in something that just gives you that returns, I think just be wary. Yeah.
Yeah, for sure,
So
for sure. Sorry, I think exactly like you said, diversification is quite important. I think talking from our point of view, the due diligence is really important. Um, and obviously, like we see in certain instances, sometimes that due diligence probably has a bit of subjective, how can I say, things going on that that we don't really know about. But yeah, diversification is quite important
mm.
in any investment portfolio. Absolutely.
Yeah, so due diligence and then diversification in different asset classes as well. But this is a scheme. Again, don't put all your eggs in well, like FTX, one basket and say, hope for the best. This will go on forever. But again, just take a small part of the portfolio and rather the rest be boring. I think the biggest, that's why diversifications don't lose money. That's lesson one about the investments. So that's not where we want to be. Ruben, what's you got from your side?
Yeah, I'm just going into. I think that this can be general mistakes, but I'm seeing this as mistakes that investors make with their tax-free savings account or their tax-free investments. It's regarding contribution limits, asset allocation, switches, and the liquidity of a tax-free savings account. So that first point, contribution limits. So Treasury has twice previously raised annual contribution limits for tax-free investments, and we all know that the current contribution limit is 36,000 rand annually and 500,000 rand over your lifetime. Now, especially when you have more than one tax-free savings account, I think you just check, where you are in terms of those limits. Remember, all contributions that's made above that limits will receive a 40% penalty fee from SARS, which is quite substantial. So that's the first mistake that I see some people do make, and then the second one is the asset allocation. A tax-free savings account, in my opinion, should be a long-term investment, and it should almost sort of complementing your retirement planning in terms of income. And obviously, when it's that long term, you can take a little bit more risk. Not paying tax on any growth is definitely powerful over the long term, and obviously not paying any tax, especially over the long term, could be effectively a higher yield over that term. And then the other mistake is switches. And once again, I think this is also a mistake that's made in normal investment portfolios or generally in investment portfolios. I think it's important to determine an investor's risk appetite before any investment is obviously made. And some investors are able to stick to the long-term plan, but some are not. Others may not be able to handle that short-term effects that volatility has on investments. And investors who can handle that volatility will most likely switch. But the investors who can't handle that volatility will mostly likely switch in and out of funds frequently, and this will lock in losses and will set you back definitely. There's a general saying in investments: time in the market is always better than timing the market. We don't know what's going on. No one has a crystal ball. Don't try and time the market. Stay invested. Invested especially for the long term in terms of tax-free savings. And then the other mistake I see people make is in terms of the liquidity of a tax-free savings account. A tax-free savings account should not be your savings account. It should not be for rainy days. It should not be for emergency funds. It should form part of a long-term plan in terms of your retirement, or maybe even debt, paying off debt at retirement, to make sure that you've got cash flow post-retirement. So I've seen many clients who use the tax-free, like I said, as emergency funds or a piggy bank. And this, of course, is because the capital is invested, it remains easily accessible. And this tempts investors to make withdrawals. You should use other investment vehicles as savings, like a savings account at the bank or a flexible investment. And remember, if you make a withdrawal, you'll never be able to put that to put that money back. You won't be able to enjoy the benefit of the tax-free investment because you take away from that 500,000 lifetime limit. So I think it's quite important for an advisor to let an investor understand exactly where these structures fit into their own portfolio, and to know what the point is of that structure, and use it accordingly. Don't use it as a piggy bank. Use it as a long-term savings vehicle. Like I said, maybe paying off debt at retirement, or supplementing your retirement income.
No, Ruvan, thank you. That's very good points that you make. And we get a lot of time the question: people want to invest for their children in a tax-free savings account in the children's name, which can be great. Or again, it's like, if you can do it for your child, let's say you can every year you put in a 36,000 rand for a child. When 15, it's finished, which is great. But now at age 18, so that is great if that child can keep that for the rest of his life. So you imagine with compound interest and not being taxed on that, what that child can literally retire from that investment that's being made. That is the power of that tool. So it's amazing. But then your child shouldn't know about it, because the problem is, if they are 18, they can withdraw that money. And that's, like you said, the biggest mistake they can make. So I normally recommend people, because 36,000 Rand a year for some clients is not a lot. For some clients, it's quite a lot. So first max out your own, you and your spouse's 36,000 Rand. And then you can start looking at your child. But again, yeah, you must just know there is consequence, because you don't want to withdraw. You really want that compound interest. And now you've got compound interest that's not taxable, which is a powerful tool. But with great power comes great responsibility. But anyway, so, and just we actually do taxes for a few clients as well, assist them with that. And I saw a client that contributed 36,000 Rand into one, and 36,000 Rand, because he knew about the limit, but he used it in two accounts, and you got to pay 40% on that. So that's a big amount that you have to pay. Expensive school fees. But yeah.
Yeah, definitely.
Okay. Thank you, Ruvan. That's all for today, and have a great weekend.
Thank you.